January 18th, 2022, 14:37 Eastern Time. The J.P. Morgan quantitative analysis team was gathered around a single monitor in a glass-walled room on the 42nd floor of 383 Madison Avenue, and they were watching something they had never seen before, a bot that refused to trade. 2 screens, same market, same timestamp. On the left, their own flagship model, 1,153 variables, 37 risk metrics, 14 machine learning layers, was frozen. Liquidity had vanished from the altcoin pair they were tracking. The model had no rule for nothing, no input, no signal, no trade. On the right, a retail bot built by someone who had never set foot on a trading floor had just entered a position at the exact moment J.P. Morgan's algorithm went flat. The engineers leaned in. The silence in the room was the kind that makes your ears ring. One of them, a senior quant named Raymond, whose specialty was high-frequency execution, said something that nobody in the room would forget. He said, "It's not supposed to be able to do that." But here is what nobody on the trading floor expected. The retail bot was not faster. It was not smarter. It had no machine learning, no neural networks, no hidden algorithms. It had 3,000 lines of Python and a single rule that a truck driver had written 18 months earlier in a rented office above a tire shop in Tulsa, Oklahoma. And that single rule was about to do something that J.P. Morgan's entire quantitative research division could not. It was about to survive a market that had become a liquidity void. You need to understand why that detail mattered. Because the quants had one assumption that shaped every line of code they wrote, every risk model they deployed, every trade they executed. They assumed that more data means better predictions. They assumed that speed wins. They assumed that complexity is the only path to edge. And in 99% of market conditions, they were right. But there is a 1% window, a specific set of hours and conditions, where the market does not reward complexity. It rewards patience. And patience is not a variable you can code. Look at the screen for a moment, not the one in the glass tower, the one in the rented office above the tire shop, the cold aluminum laptop balanced on a folding table, the mechanical keyboard with 2 keys missing, the cursor blinking on a black terminal window. The bot had been running for 93 minutes without executing a single trade. 93 minutes of watching the spread widen, watching liquidity evaporate, watching the market become something that J.P. Morgan's model could not interpret. And then, at 14:37 Eastern Time, the bot did exactly what it was programmed to do. It entered. But here's where it gets worse. Because what the bot entered was not a position that would make sense to any institutional risk manager. It entered a market where the spread had widened beyond 1.2%, a spread that signaled extreme illiquidity, the kind of condition that every HFT algorithm is trained to avoid. The J.P. Morgan model had been built to detect precisely this environment and withdraw. The retail bot was built to detect precisely this environment and enter. And that contradiction is where the story begins to break open. Now pause. Let me show you what the actual bot log looked like. Because the evidence exists. The GitHub repository is still online if you know where to find it. The commit logs are time-stamped. The code is public. And the commit message that accompanied the update is the most revealing detail of all. It read, "No changes. Bot is working as intended." In a world where every hedge fund pushes nightly updates, where every algorithm is constantly being optimized and tuned and refactored, a bot that does nothing is the rarest behavior of all. You have felt this. I know you have. The moment you open a losing position and that cold knot forms in your stomach, the urge to close it, to cut losses, to admit you were wrong before the loss gets worse. The quants saw exactly this pattern in their screen, a market that was not moving the way their model expected, and every instinct told them to withdraw. But the retail bot had no instincts. It had a rule. And the rule said, if the spread widens beyond 1.2% in the last hour of trading, enter. Exit when the spread returns to the 10-minute moving average. That was it. No market regime detection. No volatility adjustment, no machine learning. One rule, and that is where the real investigation begins. If you have ever wondered whether the market rewards stillness over speed, this is the moment to stop and internalize it. So subscribe if you want to keep tracing the patterns that institutions bury, the cargo they pad their reports with, and the one variable they refuse to model. And tell me in the comments, what is your single rule? The one condition that, when met, you enter without hesitation? I want to see the community's fire exits. Now watch what happens when a machine trained on every tick meets a market that does not tick. It freezes. And the retail bot with one indicator walks through the gap. The JP Morgan model operated on a fundamental belief about market structure, that liquidity is always present in some form, that the market always provides a bid or an ask, that the spread always has boundaries. But on January 18th, 2022, the market they were trading did something the model could not process. The spread blew past every historical parameter. The model had no training data for this. It had never seen a market behave this way because the market was behaving irrationally by every definition the model understood. And when a model encounters data it cannot classify, it does not get creative, it does not adapt, it freezes. The retail bot froze too, but that was the point. It froze for 93 minutes because the condition for its entry rule had not been met. It did not panic. It did not look for alternative strategies. It did not try to force a trade. It waited. And the waiting was not a bug. It was the feature. Here's a number you need to remember: 37%. That was the bot's win rate over the 18-month period when it was being tracked by JP Morgan's internal research team. 3 out of every 10 trades won. By any institutional standard, that is a failure. The quants saw 37% and dismissed the bot as statistically insignificant. They never checked the ratio. Because here's the number they missed. The bot's average winner was 4.3 times larger than its average loser. That ratio, 4.3 to 1, is not supposed to exist in a conventional trading model. The bot was designed to lose often and lose small, and when it won big. The quants could not simulate patience because patience is not a variable they could model. And that detail changes everything, because what the JP Morgan research team published in their 2021 paper, titled "The Unreasonable Effectiveness of Simple Strategies," was not a celebration of simplicity. It was a confession. They had spent 18 months testing single indicator bots against their multi-factor models across multiple market conditions. And they found that in illiquid markets, markets defined by wide spreads and low volume, the simplest strategies outperformed every time. The paper is real. You can find it in the JP Morgan Research Archive if you have access. And buried in the appendix is the admission they did not want to make. The performance advantage of simple strategies in low liquidity environments suggests that the marginal value of additional inputs becomes negative beyond a threshold. Let me translate that. More data made their models worse. Every additional indicator, every extra layer of complexity, every new variable, it was not helping. It was adding noise. And the retail bot, with its one rule and its one indicator, had no noise to filter. The quants had one assumption, that more data means better predictions. You have absorbed the opposite lesson through pain. I know you have. Every trader who has ever loaded their screen with 14 indicators and watched price do exactly the opposite of what every single one of them predicted, that is the lesson the market teaches through experience. More indicators means more noise. The quants learned it through research. You learned it through losses. And the bot proved them both wrong and right at the same time. But here's the part that made JP Morgan engineers sit back in silence. The bot did not win because it was smarter. It won because it was dumber. It could not overfit. It could not panic. It could not see patterns that were not there. And the market, in its most fragile moments, rewards stupidity over cleverness. The comment log from October 12, 2021 shows the last update to the bot's core logic. The developer changed nothing in the strategy. The update was a dependency fix for a library that had deprecated. The commit message reads, "No logic changes. Bot running same as always." In a world where every fund is racing to add more features, more indicators, more detection algorithms, this bot was doing something radical. It was staying still. And the staying still is what broke the JP Morgan model. Because the quant team reverse engineered the bot's logic. They decompiled the Python. They traced every variable. They tested every edge case. And they found nothing. Nothing hidden, nothing clever, nothing they could attribute the outperformance to. 1,153 variables against one, and the bot with one variable had just done something their model could not. The internal report, the one they never released publicly, contained a conclusion that the research team fought over for weeks. The final wording, approved by the head of quantitative research, read, "We cannot model the behavior of a system that has no model." That sentence is the surrender. That is the moment JP Morgan engineers sat back in silence. They were not beaten by a smarter algorithm. They were beaten by something they could not simulate, and the thing they could not simulate was patience. Let me take you back to the rented office above the tire shop. The man who built the bot was not a quant. He was a former truck driver who had taught himself to code during 30-minute rest breaks at way stations. His office had no windows that opened. The ceiling leaked when it rained. The air smelled like rubber and dust from the shop below. And every morning at 4 a.m., he sat down at that aluminum laptop and ran one back test. For 18 months, he tested one rule, across every market condition he could find. Bear markets, bull markets, sideways markets, liquidity events, crashes, rallies. He ran the back test over and over, adjusting nothing, because he was not trying to optimize. He was trying to confirm. And what he confirmed was that the market, in its most extreme moments, rewards the trader who does nothing. The quants cannot simulate that. They can simulate volatility. They can simulate spread compression. They can simulate liquidity shocks. But they cannot simulate a human being who decided, through 18 months of testing, that the best strategy is to do nothing most of the time and act only when the market becomes fragile. You know this moment. You have felt it. The screen goes still during a crash. Your indicators vanish. Your signals die. And you freeze. But here is the difference. The quants freeze because their model broke. The retail trader freezes because they are afraid. The bot freezes because it is designed to freeze. And that is the edge. The JP Morgan research team spent 6 months trying to replicate the bot's performance. They built their own version, same rule, same indicator, same parameters, and they could not make it work. Their version lost money, not because the rule was wrong, but because they could not resist optimizing it. They added a stop loss. They added a volatility filter. They added a market regime detector. And every addition made the bot worse. They could not stop improving it. And the improvement was the destruction of its edge. The builder's own notes from those 18 months survive in a Medium post he published 2 years ago, before he deleted his online presence. He wrote, "The hardest part was not building the bot. The hardest part was not changing it. Every month I wanted to add something. Every month I had to talk myself out of it. The edge is not what you add. The edge is what you leave out." That is the sentence that should be carved into every trading desk in the world. The edge is what you leave out. Read that sentence again. It is the closest thing to a trading manual you will ever find, and it is one line. If that resonates, subscribe to continue unpacking the lessons the institution cannot teach, because next we trace the pattern the JP Morgan research team buried in their own appendix. And in the comments, tell me, what is the one variable you removed from your strategy that changed everything? What was the hardest thing you ever left out? The quads could not leave anything out. Their model existed to consume data. Every variable was the result of a team of researchers who had spent months justifying its inclusion. Removing a variable meant admitting that someone's work was noise, and the organization was not structured to admit that. The bot was structured to admit nothing. Now we get to the part that the JP Morgan report did not publish, the part they filed in the internal appendix and marked as further research required. The bot did not just outperform in illiquid markets. It outperformed in a specific window of illiquid markets, the last hour of trading. The builder had found through 18 months of backtesting that the spread widens predictably in the final 60 minutes of certain trading sessions as HFT algorithms begin to close their positions and withdraw liquidity. The bot was not exploiting market incompetence. It was exploiting a structural pattern in institutional behavior. Every day at the same time, the algorithm stepped back, and the bot stepped in. The builder called it the fire exit. His analogy was simple. When a building catches fire, everyone runs for the same door. The people who designed the building know this, so they put unobtrusive exits in places you would not look. The last hour of trading was the fire exit. The algorithms were all running for the main doors. The bot took the exit nobody noticed. And that is the pattern the quants could not model, because the pattern was not in the market. It was in the behavior of the other algorithms. The bot was not trading the market. It was trading the traders. Here's what the commit log says about 1 a.m. after one of those traders who looked at his own trade log and realized something that made him close his laptop and just sit there in the dark for a while. He wrote in a journal entry that was later found by a researcher investigating the bot's history. I am not smarter than the market. I am not faster than the algorithms. But I have one thing they do not have. I know that I do not know. And that not knowing is the only edge that cannot be simulated. The JP Morgan quants could not model not knowing. Their model was built to eliminate uncertainty. Every variable was an attempt to reduce the unknown. And in a market where the unknown was the only constant, their model failed because it could not accept the one thing the bot accepted without question, that most of the time the market is random, and the only winning move is to wait. The builders who left the rented office above the tire shop never gave another interview. His last known interaction with the trading community was a single forum post, 9 words long, that has been quoted back to him in thousands of variations since. The bot only works if you trust it not to work. And that is the paradox the quants could not resolve. The bot won by not winning. It succeeded by not trying. And in a world where every institutional strategy is designed to maximize activity, the most subversive act is stillness. January 18th, 2022, 14:37 Eastern Time. The JP Morgan quantitative analysis team watched a bot built by a truck driver enter a position they could not justify, in a market they could not model, at a time when their own model said no trade was possible, and they could not explain it. The explanation was not in the data. It was not in the code. It was not in the math. The explanation was in the 18 months of sitting in a rented office, running the same back test over and over, and choosing every single day not to change a thing. The quants looked for the secret in the algorithm. The secret was not in the algorithm. The secret was in the builder, and that is the question they could not answer. Because it was not a question about code, it was a question about identity. How does a truck driver with one rule outperform a team of PhDs with $1 billion budget? The answer lies in what they never bothered to learn, that the market does not reward complexity, it rewards patience, and patience cannot be coded. One thread remains open, the identity of the builder, why he started, what he saw that the quants could not, and the pattern buried in the appendix of that internal report, the one the research team decided not to investigate further. That pattern is what comes next. In the next chapter of this story, we go deeper into the specific market conditions the bot exploited, the illiquid hours where algorithms withdraw and retail wins. That is where the real edge lives. But there's another layer the quant research team never published, a pattern in the bot's behavior that contradicted everything they believed about risk management. That pattern, the one they buried, is what we will uncover next. For now, sit with this. The bot sat flat for 93 minutes before entering. The cursor blinked. The aluminum laptop stayed cold. The air smelled like rubber and dust, and somewhere in a room that was never meant to hold a trading desk, a former truck driver watched his single indicator turn green and did exactly what he had been doing for 18 months. He waited. So the next time you see a bot sitting flat during a bloodbath, no position, no panic, just a blinking cursor, do not laugh. That is the phone welded to the tank. That is what made JP Morgan engineers sit back in silence. That is the fire exit that the algorithms cannot see because they are all running for the same door. The builder's name is known to a handful of researchers who tracked down his deleted Medium account before it was scrubbed. He did not vanish because he was hiding. He vanished because he had nothing left to prove. The bot was never the point. The discipline was the point. And discipline, once learned, does not need to be displayed. That is the kind of discipline that cannot be coded. It can only be lived. If you want to be the first to see what the JP Morgan research team buried in that appendix, the pattern they refuse to investigate, subscribe now. And in the comments, tell me, what is the hardest discipline you have ever had to maintain in your trading? I read every single one. But here's the part that stays with you after the video ends. The pattern buried in the appendix of that JP Morgan internal report, the one they did not publish, was not a flaw in their modeling. It was a flaw in their understanding of what a trader is. They assumed that a trader is someone who acts. They could not conceive of a trader who acts by not acting, and that blind spot cost them more than they will ever admit publicly, because the bot is still running, somewhere. The repository is private now, but the code is out there, copied, forked, studied by a generation of retail traders who realize that the edge is not in the algorithm. The edge is in the willingness to sit still while everyone else is sprinting toward the exits. The cursor is still blinking, the aluminum laptop is still cold, and somewhere in a room that smells like rubber and dust, a former truck driver is watching a terminal he has not touched in 2 years, because the bot does not need his attention anymore. It only needs his absence, and that is the edge. Not a better model, not more data, not faster execution, but the simple, unbearable discipline of leaving it alone. That is what the quants could not simulate. That is what they surrendered to. And that is what you already have, sitting in your hands every time you close your laptop and walk away from a market that will not stop screaming. The phone is welded, the tank is still, and the only move that beats a model designed to move is not to move at all. The JP Morgan researchers named their internal project the Observing Mirror because that was what the bot became to them, a surface that reflected back their own assumptions. Every time they tried to test it, they discovered something about their own thinking. The bot never changed. It was the mirror that showed them what they could not see about themselves. The senior quant, Raymond, the one who first said, "It's not supposed to be able to do that," spent 3 months after the project concluded rewriting his own personal trading rules. He had been at JP Morgan for 11 years. He had published 6 papers on high-frequency execution. He had taught machine learning to a generation of junior quant analysts, and he told a colleague in a conversation that was later included in an internal review that the bot had taught him something his PhD had not. He said, "I spent my entire career trying to be right more often, and the whole time the market was rewarding people who were okay with being wrong most of the time, as long as they were right at the right moment. That is the lesson the institution could not institutionalize. You cannot train a team of PhDs to be okay with being wrong 70% of the time. Their careers depend on being right. Their funding depends on being right. Their models are built to optimize for being right. And the market, in its quietest moments, rewards the trader who is comfortable being wrong, because being wrong is cheap when the losses are small and the wins are large. The bot's win rate never improved. The commit logs show no attempt to improve it. The builder left the code exactly as it was because he understood something the quants could not accept, that a 37% win rate with a 4.3-to-1 reward ratio is not a weakness. It is a structure, and the structure works exactly as designed. So when you look at your own trading history, the wins you remember, the losses you try to forget, the ratio that never seems to make sense, ask yourself a different question. Not, how do I win more often? That is the quant's question. The quant asks that question because their model is designed to maximize frequency. But ask instead, how do I make my losses smaller than my wins? That is the builder's question. And the answer is not in a better indicator. The answer is in a rule you have the discipline not to modify. The builder is not coming back. His Medium account is deleted. His repository is private. The forum account that posted those 9 words, "The bot only works if you trust it not to work," has been inactive for 3 years. He left behind no course, no mentorship program, no paid community. He left behind one rule and the discipline to execute it, and that is the only inheritance that matters. Every single day, somewhere in the world, a retail trader opens their laptop, sees a screen full of indicators, and feels the old familiar pull to add one more, to optimize, to tweak, to improve. That pull is the institution's ghost. It is the voice of every quant who ever believed that more data means better predictions. And that voice is wrong. The bot that broke JP Morgan had one rule. The market it beat had infinite complexity. And the resolution of that contradiction is the closest thing to a permanent edge that exists in trading. You already know what the rule is. You have known it the entire time you have been reading these words. The rule is not a secret. It is not hidden in a GitHub repository or a DOJ filing or a research paper. The rule is simply this: the market rewards patience more than it rewards cleverness, and the hardest thing to do, the thing the institution cannot replicate, is nothing. The blinking cursor is still on the screen, the aluminum laptop is still cold, and the former truck driver who built the bot is probably not watching. He does not need to. The bot does not need his attention. It only needs his discipline, which is already built into the code. The question is not whether you can build a bot. The question is whether you can leave it alone. That is the edge. That is the fire exit. And that is the only thing that made JP Morgan engineers sit back in silence. Because they could not code it, they could not buy it, and they could not simulate it. But you do not need to simulate it. You only need to do it.